so excited to be chatting with you here today. Hope you're having a great morning, afternoon, or evening, depending on where you are in the world. Hopefully this is going to be a super informative session. Decentralized finance is probably one of my favorite topics in the world. It's probably less than 4 years old at this point, but it's absolutely growing like crazy, and has kind of spawned tons of new startups, new developers, new jobs, new interests, new capital flows. And so my job here today is to share that with you, hopefully make it fun and accessible, so that you can kind of learn a little bit more about the DeFi space, and also have kind of a conversation back and forth. So as Anthony mentioned, please don't hesitate to type up questions. We're going to be pausing at a couple different places throughout the presentation. I want to make sure this is accessible, and so if there's something that's not clear, please just reach out, and I can go further into any individual topics or clarify things as needed. But again, so excited to be talking about DeFi. It's pretty much my favorite topic in the world. So let's get into it. First off, so a little bit about my background. I started off kind of in the consulting and the enterprise SaaS space. So, building out and customizing CRMs, automation in large insurance and financial services companies, kind of working with the old guard before making a jump over to the blockchain and DeFi space about 5 years ago. I did find my way to a couple of the largest financial firms in the world, and spent about 4 years at Millennium and Bridgewater, where I was dealing with some of the most complex trading systems, making crazy interesting trades all around the world across all these different markets. And that's really where the seed of my interest in blockchain and eventually in DeFi kind of came from. So I come from the traditional finance world, but have been now in the blockchain space for about 5 years. But about 5 years ago is when I left Midtown Manhattan and went out to like a warehouse in Brooklyn and met ConsenSys. At the time, it was a bunch of hackers in a warehouse talking about this crazy Ethereum thing. And we've basically been able to be part of this industry completely opening up over the past 5 years or so. Gone from like a very, very niche kind of nascent industry into something that now has billions and even trillions in some cases of dollars flowing around. And that's just been exciting to watch that growth. In my current role, I'm head of product at ConsenSys Codefi. So we build all the financial applications that ConsenSys puts out. For instance, we built the swaps button that's into MetaMask. If you've used MetaMask before as an Ethereum wallet, if you click the swaps button, we go out and find you the best token prices on all the decentralized exchanges that are out there, and give you a super easy user experience to make whatever kind of token swaps you'd like to do. We also have a version of MetaMask called MetaMask Institutional that's aimed at the more professional traders, the crypto funds, the trading desks, with some kind of more professional features aimed specifically at them. And then, of course, we have tokenization and payment software that's being used all around the world. So I first gave this talk about a month ago to a university class here locally at Duke University. We're going to be covering a whole array of DeFi topics. We're going to go through a general definition of what is DeFi, how did we get here, all the way from Satoshi Nakamoto up to Beeple selling an NFT token for $69 million recently. We're going to talk about how DeFi is emerging as the killer app for this permissionless blockchain space. You guys have probably heard about blockchain as a term for many years now, and we finally know kind of what the killer app of these blockchains are going to be, and that's kind of what we sum up as DeFi. I'm even going to take you through 10, so read it, 10 different major use cases for DeFi. So your knowledge should go, if it's on 0 today, I want you ramped up all the way to 100 by the end of this conversation. After that, we're going to talk about the most cutting edge developments within DeFi. So these are things that you can't even do with the traditional financial system, but you can do with financial services built on top of Ethereum and built on top of crypto. So that's very much the forward leaning type stuff. And then we'll finish off looking ahead at what you can expect from the sector over the coming months. Before we get into that, I just want to kind of have a couple caveats for this talk. So this talk was originally put together for university students that were studying blockchain. So there is a little bit of crypto knowledge required, right? We're not going to be getting into the nitty gritty of what is is a blockchain? What is Bitcoin? How do I send a simple transaction? I'm assuming you've maybe bought or sold some coins or tokens here. Maybe you have a Coinbase account. Maybe you have a MetaMask wallet and have traded on Uniswap. So I'm assuming that you have a little bit of basic crypto knowledge as we go very, very deep on these DeFi topics. That said, I'll try to explain everything in very kind of colloquial, easy to understand type terms. And then at certain points, I'll say we're going deep, and then we'll go heavily into the technology for our more advanced users. Second caveat is some of my charts are out of date. You'll have to forgive me. This sector is growing so quickly. As soon as we put our slides together, they end up being slightly out of date because the growth has ticked even more upwards. And I did put this presentation together about a month ago. So excuse if any charts are slightly out of date. And that's especially around non-fungible tokens or NFTs. They're kind of having a moment at this point. And so, even our charts from 3 or 4 weeks ago are now out of date because they've absolutely exploded in growth. Third caveat, we're going to be discussing crypto as a technology today and not as an asset class. So when I say crypto as an asset class, there are financial institutions all around the world that are looking at adding Bitcoin or Ether or some other forms of tokens to their balance sheet or to their funds, or starting to talk about those with investors. We're not going to discuss that here today. I'll probably mention price once or twice here and there, but we're not going to be talking about crypto as an asset class. There are plenty of webinars and talks about that elsewhere around the web. We're really going to be talking about crypto as a technology and DeFi as a technology and how that's going to change the financial system over the coming 3, 5, 10 years in the future. And lastly, the last caveat is just this entire presentation are my own thoughts and opinions, not any kind of recommendation from ConsenSys. So take it for what you want. All right, so what is DeFi? Let's start from kind of the very beginning. I like to keep it very, very simple. It's just any financial service or application built on top of blockchain or Web3 technology. So if you're building any application on top of blockchain or Web3 technology and it has any kind of financial component, whether it's payments or points or rewards, any component like that, we kind of consider it DeFi. The kind of ecosystem as a whole likes to think of DeFi as the internet of money. So we think of the information internet that sprung up in the 90s. You had Yahoo and then Google and then Facebook and all these companies that make it really, really easy for us to communicate with anyone else around the world, right? And we've seen how massively impactful the internet has been today. Well, we believe that blockchain is going to allow you to do the same thing with sending money, sending value, or building out financial services with anybody around the world. And this internet of money is kind of just getting started today. But you can see, the growth from 2018 to 2020 has been pretty astounding, and it's only kind of going up from there. One other point that I really want to make here too is that, in certain ways, crypto is tapping into the existing financial system that exists around the world with a lot of the big banks or the credit card networks, the SWIFT networks, but it really is its own kind of parallel financial system that's springing up. What we're really seeing is for any type of financial service that exists today, we're seeing the equivalent arise in the DeFi world, right? So the very obvious ones are, we started off with money. So, we obviously have the US dollar, the euro, the yen all around the world. And we have things like Bitcoin, Ether, DAI emerging as forms of money that are completely crypto native. But all the financial services that are built on top of the traditional financial system, whether it's central banks, investment banking, exchange, lending, payments, insurance, all of those financial services that we use today or our businesses use today are now having counterparts that are being built on this crypto internet of money from the ground up for the internet age, right? So, let's take, for instance, the New York Stock Exchange or the NASDAQ. So I can go on there and I can buy some Tesla shares through a variety of brokerages. And that's been around for decades at this point. Well, now we have the equivalent in something like Uniswap or SushiSwap, where I can go and trade any kind of token with a couple clicks. The main difference here is Uniswap and SushiSwap is very much built for the internet age, right? So on this side, where the New York Stock Exchange or the NASDAQ is a very heavy organization with thousands and thousands of people and tons of paper and pencil processes and tons of filing cabinets, right? We have the equivalent exchange venues built with Uniswap and SushiSwap that are just thousands of lines of code, and everything's just a little bit more automated. And so for things like exchanges, you're seeing the equivalent over here in the DeFi universe. And all the other financial services are the same way. So lending services, so you can go to your bank and take out a loan to get a mortgage. We have lending services now within DeFi with Aave, Maker, and Compound. For insurance, we have AIG and Liberty Mutuals of the world. We have Nexus Mutual and Cover and insurance providers now in the DeFi world. So if you take away one nugget from this entire conversation today is, DeFi is just a new version of these financial services just built for the internet age on top of smart contract blockchains like Ethereum. And it's a very small industry today that's growing very rapidly, and we're quite excited about it. So sometimes DeFi and the blockchain space in general can be a little bit hard to approach. You get all these weird terms like tokens and protocols and governance, and they're unicorns and rainbows everywhere. I really encourage everybody to kind of push past that, right? If you were walking into your bank for the first time today and you had absolutely no context, like a lot of those terms would be very confusing. I think what you kind of have to boil it down to is from a first principle standpoint. At the end of the day, people want to send payments back and forth. People want to be able to borrow cash. People want to make a yield on their earnings. All those types of things are emerging in DeFi in this internet native way, just as they exist in the financial sector today. And so don't be too confused by some of the crazier terms or the more creative products that you see. So how did we get to DeFi? We're going to go through a quick crypto history here. So starting back in, I'm sure everybody on this call knows it, but starting back in 2009 and 2010, Satoshi Nakamoto created Bitcoin. And frankly, it didn't do much for the first couple years, right? It was basically a niche group of cryptographers that were running these nodes all around the world and maybe sending a little bit of value back and forth around the world. All of a sudden, we had one of the first price run-ups in 2013, right? Crypto actually goes through these kind of 4-year price cycles where maybe the price goes up for a little bit, but what's more important is every time that happens, the amount of media attention, the amount of people that are getting themselves educated on crypto just increases quite a bit. So we had the 2013 kind of price run up, and that led to really successful projects like Ethereum launching in 2014. And eventually, I'm sure everybody on this call remembers, we then had another kind of crypto price run up in 2017 around this kind of ICO mania. Now, the difference between these two different cycles between 2013 and 2017 was now we have smart blockchains, right? So on the Bitcoin blockchain, you can just send a little bit of Bitcoin back and forth, right? I kind of equate it to a very simple calculator, right? You can just do simple addition and subtraction operations. But Ethereum is completely programmable. So I think of that as a graphing calculator or a programmatic calculator. You can create programs within this whole blockchain. And that's how we're building all those financial services that I mentioned earlier. 2017, we basically innovated on the fundraising front, right? So new fintech companies, rather than going out to VCs for raising capital and raising a seed round and a Series A and you're getting customers and getting off the ground, they just said, hey, I'm going to go direct to consumers, right? And they encoded this fundraising logic into the Ethereum blockchain, and ran these token launches or these ICOs that raised money for their project, and then they were going to go out and execute and build. I'm not here to judge. There was both good and bad activity that happened in 2017. Some of the best projects that are around today originated in that time frame. Some of the developers and best entrepreneurs in this entire space got into the space in 2017. So there was a lot of good activity, but then there were a lot of quicker cash grabs and scams, and there was a lot of disillusionment from some of that ICO activity. We went through the past few years, we've been going through kind of a little bit more of a down period where everybody was building, bootstrapping with users. The technology and the libraries got so much better. The user experience got better. And we ended up here at 2021 today, where we're kind of in that next 4-year cycle. What's different about it today is, rather than in 2017, where people might fundraise based off an idea, or fundraise based off their background, or fundraise based off just like a white paper PDF, today these applications have millions of users. They have billions of dollars of capital flowing through them. They're providing the equivalent financial services that you can go to Bank of America, go to Robinhood, or go to Venmo to participate in. So the maturity of the industry just makes leaps and bound jumps on each of these kind of 4-year cycles, and that's why we're so excited about all the activity that's happening in 2021. So the growth has been astounding. No matter which metric you use to kind of chart the industry, whether it's unique users, whether that's the amount of capital that's flowing in, whether it's the amount of accounts being opened at Coinbase or Binance, no matter how you kind of chart the growth of the DeFi sector, it's very much up and to the right. And the explosion of innovation and new startups and entrepreneurs in the space is just absolutely astounding. Again, my charts are even a little bit out of date because it's impossible to keep up with some of the growth here. So this is both a saying I like to say that's probably the most dangerous thing I'm going to say on this call today, but this time is different, right? So, we talked about the 2013 to 2017 cycles, where a lot of the activity that fueled these, incredible cycles was speculative. This time it's a little bit different. And I'm not saying that, it's not that speculation takes no part in it, but the fundamental value that these services are providing are 100x greater than they were even 2 years ago, even 4 years ago. It's kind of being like involved in the App Store right after it opened for the iPhone, right? Or it's involved with, or it's similar to being like one of the first major websites on the internet. You have this entirely new technology breakthrough, and there are these early participants that are kind of playing around, finding the killer apps, and then seeing that initial user growth as it kind of crosses the chasm into more mainstream technology. And we're 100% kind of in that chasm phase for DeFi. And anytime that we have a price run up like this, we make leaps and bounds jump forward for the amount of folks that are getting into the space and the applications that they're using. So, one big takeaway is DeFi is emerging as the killer app for these permissionless blockchains like Ethereum and others that you've heard about. We're going to be getting into those top 10 use cases here in a second, but I do want to talk through a couple key projects so you guys kind of get the lay of the land a bit. Here at ConsenSys, we track a couple very important metrics, things like the number of users that are interacting with DeFi, what are the applications they're using, what are the types of services that they're interested in, and a lot of those top services are on this list right here. Starting out at the top here, talking briefly about Chainlink. So Chainlink is probably one of the biggest data providers within DeFi today. So if you need any kind of off-chain data, like let's say, the value of the S&P or the value of the Tesla share price, but you need that within your smart contracts, you're more than likely going to go through Chainlink or another oracle to get that data, right? And Chainlink has become this kind of infrastructure for powering a lot of these top DeFi financial services today. Similarly, I'm going to go into these in depth here in a second, so I'll just touch on them briefly. We have Uniswap and SushiSwap, which are two of the biggest decentralized exchanges or DEXs that are in the ecosystem. And you can kind of think of these as the equivalent of a Coinbase or a Binance, but again, they're entirely written into smart contracts on the Ethereum blockchain. So rather than being an incorporated company with thousands of employees and an HR department and a marketing department and a bunch of TPS reports that get passed around, these things are just several thousand lines of code that you can do similar functionality as these massively valuable startups are doing. Another popular application are lending applications. So we'll talk about Aave, Compound, and Maker here in a second. Just like you can go to your bank and get a loan to go buy a house or to go get a loan to buy a car or what have you, you now have lending facilities that are, again, encoded into smart contracts. So rather than bloated banks with a bunch of people and bosses and filing cabinets, you now have several thousand lines of code that are doing a similar type of service that's completely completely open and much more transparent than those kind of banks are traditionally. Other ones I'll just quickly hit on. Wrapped Bitcoin is a really interesting one. So, the Bitcoin blockchain is the blockchain that's kind of has the biggest market share for kind of the store of value narrative. What I mean by that is just as institutions or governments or asset managers are getting into the crypto space, they generally look at Bitcoin first, and they look at Bitcoin as a hedge against holding traditional fiat currencies like the USD or the euro, or these currencies that are backed by a government entity. They say, Bitcoin has a fixed inflation schedule, and so a part of my balance sheet should sit in Bitcoin so we're not exposed to the kind of volatility that these governments might introduce for their own currencies. Wrapped Bitcoin is interesting because it's taking Bitcoin from the Bitcoin blockchain and it's allowing a tokenized version on the Ethereum blockchain so that it can participate in all these interesting financial services that we've talked about, whether that's exchanges like Uniswap and SushiSwap, whether that's lending facilities like Aave, Compound, and Maker. That's a way that you can then take Bitcoin and make it useful in this new financial system by porting it over to Ethereum. Lastly, you'll hear me talk about DAI a little bit when we talk about stablecoins. DAI is just interesting just because it's the main project from the Maker Foundation, and it's a stablecoin that exists entirely within smart contracts. We'll talk about some stablecoins that are put up by banks and financial institutions, but DAI is more unique in that it is completely smart contract based. So if you're going to look into projects after this call, I'd recommend taking a look at this slide, screenshot this slide, and look into these projects to get a little bit more up to speed. Okay, so we've talked about blockchain and DeFi being the internet of money. So because it's the internet of money, there are certain layers that make up the protocol that makes you be able to build all these interesting financial services on top of each other. At the base layer, you have the actual Ethereum blockchain. It operates similar to any other blockchain where you have a string of transactions that get clumped together. I'm not going to go too far into that, but because Ethereum has smart contracts, you can basically build any application you can dream up into it, right? One of the most popular things that gets built into it are different types of tokens, right? So you have ERC20 fungible tokens, and then you have non-fungible tokens as well. Last time I checked, I think there are over 250,000 fungible tokens that have been built into the Ethereum blockchain. And the vast majority of those have, no or very little value, right? They are mostly developers playing around, maybe deploying a token that, represents a test or represents themselves in some way, shape, or form. But at the top end of the market, some of these big projects have launched tokens that actually you can do things, right? By owning the token, you can vote or you can participate in these different financial services, and they kind of make up the core of what gets built here at the protocol layer. So as I mentioned before, I gave this talk a month ago, and I kind of I went over NFTs and non-fungible tokens very, very quickly. In the span of those 3 or 4 weeks, now you can learn about NFTs in the New York Times and the Wall Street Journal and CNN and CNBC. So I would say that they're having a bit of a moment right now, but any type of digital art or collectible or gaming item can be represented as these non-fungible tokens, and then can have their certificate of authentication and their trading history all recorded on the blockchain. And it's a very emerging space at the moment. All right, once we have assets, we want to do things with those assets. So we go to the protocol layer, where you can have exchanges, lending facilities, derivatives facilities, and asset management protocols, as well as a slew of other things. I'm going to briefly skip this one because actually those top 10 use cases that we'll get into for DeFi cover these main areas. Lastly, you have the application layer. So how do users actually access these different, interesting financial services they can use? There are a number of different wallets and other, web applications that you can use that, end up looking kind of like your traditional bank account, or kind of like your Robinhood account, where you can, access all of these types of things. Here at ConsenSys, we run MetaMask, and that's usually, our portal to this wonderful DeFi world. And you have aggregators on top. I absolutely love this diagram for describing the different layers. And it wasn't just built by myself or somebody at ConsenSys. This was actually put together by the St. Louis Federal Reserve Bank, right? So 5 years ago, it was a bunch of hackers hanging out in a Brooklyn warehouse, and all of a sudden now the traditional financial players are leveling up and putting out best in class content about this innovative DeFi space. All right, so these are those 10 use cases that we're going to go over, and we're going to spend the back half of our time discussing them. I've segmented them into these 3 different categories. So think of this as beginner, intermediate, and then expert. So for our first section, we'll talk about some of the most foundational elements of the DeFi space. That includes stable coins. We'll talk about a couple of these projects. Next, we'll talk about trading tokens or spot market, or those decentralized exchanges that we talked about earlier. They're probably one of the most active applications that are occurring on smart contract blockchains today. After that, we'll then talk about those lending facilities, including Aave, Compound, DYDX, and Maker. Though I'm going to make some analogies to traditional kind of banking applications, and then we'll talk about how the smart contract versions are different. And then we'll go a little bit deeper down the rabbit hole. And then towards the end of the presentation, we're going to talk about some of the crazier stuff. So these are the things that you can do with crypto financial services that you can't even do on top of your bank or the traditional financial system. But before we get started, Anthony, do we want to take a look at the poll and go over any outstanding questions?
Yes. So the poll is ending now. And the first question was, how experienced are you with DeFi? I would say about roughly 34% are starting to learn, 33% own some coins, 28% play with DeFi, and about 5% are experts. So it's a good distribution. The second question, what's your favorite way to use MetaMask? 3% was gaming. Using a DAO was about 6%. DeFi, about a quarter, 26%. Payments, another quarter, 21%. Swapping tokens, 20%, about a fifth. And other 25%. So it's pretty well distributed as well between DeFi, payments, and swapping tokens. What's your favorite DeFi application? Uniswap comes in at about 37%, Aave is 10%, Compound 8%, Yearn 3%, and other a whopping 42%. Maybe you can put in the comment section your favorite DeFi application. What is your biggest roadblock to engage with DeFi? Gas fees is 35%. This is by far the most outstanding one. Lack of information education is almost tied, 34%. UX UI, it's 8%, surprisingly. Fear of security is 11%. Fear of using seed phrase, we have some very sophisticated people here, only 1%, which is congratulations. That is quite a hurdle. And other is 11%. So questions. Thank you again, guys, for answering these. We'll pick 2 or 3 questions. And then from there, any questions that are not answered at the end of the webinar will be answered afterwards, or I'll be typing away. So one quick question would be, I saw here, let's see, we have here, it was really interesting. There's a lot of questions. Thank you, guys. Okay, we'll get to the regulation questions later. How can DeFi be compatible with CBDCs? It's a totally different approach from central banks.
Oh man, great question. So for those on the call, so CBDCs means central bank digital currencies. So Bitcoin, Ether, DAI, USDC, these are all digital currencies or digital assets. Central bank digital currencies are tokens or coins that are issued by a central bank, just like the US dollar, the yen, the euro is issued, right? What we're really excited about CBDCs for is, I think everybody on this call can agree that the majority of our life is digital anyways, right? A lot of us work online. We talk to our family over FaceTime. We get entertainment over, online. And so much of our life is digital anyways. Our money is actually pretty much already digital as well, right? If I make a payment to go out and buy my coffee, and I'm not paying in crypto, if I'm paying with US dollars, what's actually happening in the background is, our 2 banks are talking and are reconciling, and they're then figuring out, debit my account and then credit their account, right? What CBDCs are doing are saying, hey, this is a pretty heavy system, getting all these different institutions involved just to buy a simple cup of coffee, right? So how can we make a more efficient system for doing something like that? Enter CBDCs, right? So they're looking at using blockchain technology or something called DLT, or possibly something a little bit more centralized to create their own digital currency, because they think that creating a currency for the internet and age is going to make it a lot easier for them to administer and manage going forward.
Excellent. Another question. Please explain why a borrower would want to over-collateralize a loan. What is the decision to lock up X amount of ETH to get 66% or some percentage of a coin? What is the status of building under-collateralized loans?
That is a great and pretty nicely advanced question.
Yep.
Great question. We're going to be talking about lending here in a second, so I'm going to hold off on that mostly. All I'll say is, yes, we've started with over-collateralized loans, and those are the majority of the lending activity that's happening today. But I'll give you guys a taste of some of the non-over-collateralized lending activity that's starting to emerge as well.
Excellent. So on to the next section, and we'll keep on answering these questions async. Thank you, Corbin.
Awesome. Great. So this is going to be our getting started section, where we're going to be talking about the foundational aspects that pretty much make up a lot of the other services we're going to be talking about in our later column. So we're going to be talking about stablecoins, trading or decentralized exchanges, and then lending, and we'll get to that over collateralization question. So let's start off with stablecoins. So little bit of a history lesson. So back when Bitcoin was created back in 2009, 2010, everybody's always kind of had this dream that we were going to use digital currency for peer-to-peer consumer payments or to go, buy your coffee, right? I can send somebody a little bit of Bitcoin, they give me a coffee, and we go on our merry way. The problem is Bitcoin in and of itself is actually a very poor means of exchange when it comes to digital currency. Right? Number one, it's volatile, right? There's the classic Bitcoin pizza story of somebody sending, I think it was 50,000 Bitcoin to pay for a pizza. Now that's worth billions of dollars, right? If I'm using something for payment, I want to make sure that $10 is $10 today, next week, and for the most part next year, right? So I don't get burned by some of this volatility. On top of that, for Bitcoin specifically, new transactions take about 10 minutes to actually go through or to settle. And so I would actually have to sit there and hang out with my coffee for 10 minutes before I'm allowed to actually finish payment and go on my merry way. So everybody's kind of wanted to see this, peer-to-peer payment use case come to fruition, but it hadn't until stablecoins. So stablecoins sprung up about 3 or 4 years ago. We'll talk about the different stablecoin types, but basically what I mean by stablecoin is just an asset that's worth roughly the same amount today, next week, and next year. Right? A lot of these are pegged to the US dollar. So one token equals $1. And you can use them for all these financial services that we're going to talk about, just like you would use dollars in your bank account today. Stablecoins are really foundational. And if we didn't have stablecoins, a lot of the other innovation that we talk about later on in this presentation just wouldn't even be possible. So that's the high level definition. Now we're going to go a little bit deeper. So there are basically roughly four different types of stablecoins: asset-backed, debt-backed, synthetic, and algorithmic. Now, asset-backed and debt-backed are by far the most common. Asset-backed, like USDC here, or Tether or Binance USDC here, basically what they mean are there's a financial institution that puts $100 million in a bank, and they create 100 million tokens on the blockchain. And then they allow users to buy those different tokens and can use them back and forth in these decentralized exchanges or these lending venues. And those users always know if they need to, they can redeem that one token for $1 US through this financial institution, right? By far, I think Tether is probably the biggest stablecoin in terms of trading activity. And then USDC is rapidly catching up in terms of commerce between a lot of these DeFi applications. Similarly, you have debt-backed stablecoins like DAI, and there are a few others out there as well. What debt-backed stablecoins are some kind of lending activity, and we're going to go into lending deeply here in a second, but there's some kind of lending activity, and that lending is denominated in this DAI token, right? And because of the way the system is programmed, basically that DAI token always stays the same as some type of asset. In DAI's case, it's the US dollar, right? The big benefit there, we talk about centralization and decentralization. These debt-backed stablecoins are generally all smart contract based, are completely permissionless, and are completely uncensorable. So that means everything about DAI happens in the smart contract, right? So if DAI is sitting in my wallet, there's no financial institution in the world that can come grab it out of my wallet or manipulate the price or run away with my tokens. It's all completely trustless and all completely on chain. These asset-backed stablecoins, there's kind of a man in the middle, which is totally fine. It's just a little bit more centralized, right? So we have Circle in the case of USDC and other folks that issue these asset-backed stablecoins, and you're depending on that organization to redeem you $1 if you give them one token, right? So you're just making a little bit of a different trust assumption if you're working with asset-backed stablecoins versus debt-backed stablecoins. The last two categories get a little bit crazier. So we have synthetic stablecoins. That's basically saying we're going to put a bunch of tokens or value in a pot, and then we're going to issue you basically kind of an IOU that says this token is worth $1 at all points in time. You can redeem it into this big pot of tokens for that amount, and it relies on oracles or off-chain data feeds to maintain that kind of stable price, like the Synthetics USD token. And then the last one, which is kind of a little bit of the craziness, is what's called an algorithmic stablecoin. So how that works is basically you have a bunch of tokens and they control the minting and the burning of those tokens based on how the price is going, right? So if the price trading back and forth all the time, if the price gets a little bit too high, they're going to create more tokens, pumping supply into the ecosystem to push that price down a bit. If the price is trading a little bit low, they're going to They're going to start burning tokens so the price catches back up to whatever peg they're looking for. Algorithmic stablecoins are incredibly innovative, but they're not as widely used today. All right, so that was stablecoins. Super important to everything that we're going to be talking about, especially decentralized exchanges here, or I'm going to shorten it and call it DEXs. So DEXs are probably one of the first major killer apps to emerge on top of blockchains and on top of DeFi. You can see that the trading volume and the fees collected from trading have gone through the roof, and into 2021, these continue to go very much up and to the right. Some of the biggest players in the space include Uniswap, SushiSwap, 0x, and Curve. For just some kind of real world comparable here, so basically you go to one of these decentralized exchanges. If you have one token, you have Ether, and you want another token like USDC, right? This is a venue where you can go and exchange your Ether for your USDC or any other token swap that you can kind of dream up. You can do something similar if you use what's called a centralized exchange, right? So you can download the Coinbase app, you can get on Binance, and you can trade tokens in a venue like that. But again, that is a whole startup with a bunch of people and a bunch of processes and a bunch of databases and software engineers that run Coinbase and Binance. Uniswap, SushiSwap are just a collection of smart contract code, right? Thousands of lines of smart contract code that are doing kind of an equivalent service to what those super valuable startups are going to be doing. The most interesting one is, so Uniswap decentralized exchange volumes actually rivaled, if not beat, Coinbase monthly exchange volumes for the past few months. So on one hand, we have Coinbase, a startup that's likely going public later on this year, worth probably upwards of $100 billion. On the other hand, we have a couple thousand lines of smart contract code that's doing an equivalent service and doing it at higher volumes in some cases. So it's really interesting to watch the differences between the two. Going a little bit more deep now. One of the reasons people really like decentralized exchanges is because they're completely open and permissionless. What that means is anybody around the world can get on there and kind of trade with this, couple thousand lines of code, right? There's no sign up, there's no personally identifiable information to hand over. Anybody can interact with this as long as they have an internet connection, right? Because of that, anybody can build on top of these decentralized exchanges as well. Right. So, if you're some kind of programmer, you're some kind of, technical trader, you may want to build an application on top of Uniswap, and you don't have to ask anybody's permission, right? the design space for what you can build is only limited by what you can dream up, right? You're not limited by a company's API documentation. You can go read the code yourself and get started right away. And so one of the things that we've seen in this DeFi space is you end up with a bunch of these financial Lego blocks that you can then stack in different ways together and build new types of services that aren't even possible with the traditional financial sector. So, decentralized exchanges, super important application in the space, and then also a major building block for a lot of the other use cases that we're going to talk about later. All right, so our final topic for our getting started section is lending platforms. So we got Aave, Compound, and Maker here. The completely traditional financial world equivalent is something like your bank and your savings account, right? So I've always been a Bank of America user. I've had a Bank of America saving account for since I was super young. I basically I put some of my money in there, and then Bank of America, with its hundreds of thousands of employees and people and processes and file cabinets, takes that capital, they aggregate it all together, and then they issue different types of loans or different financial services. So if you're a small business and you're like, oh my gosh, I sell remote standing desks and they're going crazy during the pandemic, I need a loan, Bank of America, so I can grow my business. Bank of America is going to say, hey, absolutely, like, we want to support you. We're going to charge you 15% interest, but we're going to give you this $1 million loan, expand your business and pay us back at a 15% rate. Bank of America then uses all that revenue to kind of run their internal operations. And then they give me, who opened their savings account, a wonderful 0.5% of interest every single year for banking with them. On top of that, they charge me fees and all types of other, clunky websites to navigate around, right? So that's one form of lending that, happens in the traditional financial sector. What a lot of these protocols are doing are saying, hey, similar to what Uniswap and SushiSwap are doing for exchanges, we can do that entire thing, but we can do that in a couple thousand lines of smart contract code, right? So I can actually deposit my capital into any one of these protocols. On the other side, borrowers can take out loans against my capital. And because these are just programs, right? They're not these, hundreds of thousands of people within an organization. Banks are some of the biggest businesses in the world. Because these things are so much smaller, instead of me only getting 0.5% on my capital that I deposit, I get the bulk of that 10% or 15% that I deposited, right? So, it's a much more streamlined middleman connecting depositors and borrowers to fulfill this kind of lending facility. And, it's absolutely crazy, to see the growth in this sector. And we're super excited about lending just as a concept within DeFi. So we had a question earlier about over-collateralized loans. So we're going to go deep here for a second. So the question was, all of these different lending facilities provide what's called over-collateralized loans. What that means is you have to put in collateral to actually borrow against it. So you have to over-collateralize. So I have to put in $150 if I want to take out a $100 loan. You're asking, why would I ever want to do something like that? That makes absolutely no sense. Well, you can do it across asset types, right? So I could deposit my Ether, right, and put that in my savings account, but then I could take a loan in USDC and actually go use that to buy a house or buy a car or make kind of everyday payments, right? I still have to pay back that loan over time, but I can deposit one asset and take a loan in another asset, right? And that's what these over-collateralized loans are kind of was the first lending use case to come to market. There are basically 3 reasons why you want to do an over-collateralized loan. The first 2 are trading based. So if you want to trade on leverage, or if you want to short a particular asset, you need to be able to borrow against it, right? Or take out a loan for it. So, I won't go through the series of transactions, but you can go through a series of transactions to trade on leverage or to short a particular token using these venues. So very trading focused. The third use case is what I mentioned with those cross asset lendings, right? So, Bitcoin's gone from, 12,000 to 50,000 in, the past little bit. What if I want to, actually, go out and, buy my wife something nice with some of my Bitcoin gains, but I don't actually want to sell my Bitcoin because I still think it's going to go up further in the future, right? rather than having to sell my Bitcoin, so I don't have future appreciation, and then I also have to pay possible tax consequences from that selling transaction, what I can do is deposit it as collateral and take out a loan against it to go buy my wife something nice, and I can pay back that loan over time without having sold my Bitcoin, right? So that's short-term liquidity on some of your crypto assets is that third use case. And we're actually seeing that grow leaps and bounds in this crypto cycle. As some prices have gone up in appreciation, people want to access to that capital without having to actually sell their crypto. And so we're seeing that pop up quite a bit. We had a question about over collateralized loans too. I'm gonna go super in depth here. So a couple things. So there are a couple different emerging ways you can actually do non-over collateralized loans. One of the best ones is with Aave. They have a delegated credit system. So basically somebody else puts up the collateral, but they delegate borrowing power to a third party that maybe they have a real world relationship with, or they trust in some extent. And that third party can actually borrow funds without having to put up collateral themselves, right? So somebody's delegating their borrowing power to a third party, right? And you provide these, you provide loans that actually don't have to even be backed by collateral. There's also a couple new protocols that are coming out that utilize some form of on-chain reputation to provide loans without having them to be over collateralized, right? In the real world, we have things where it's, especially in the US, we have things like credit scores that allow you to, allows a bank to assess your credit worthiness based on your behavior and your kind of past, your past behavior. We're getting the equivalent of crypto, reputation that are going to be kind of a gateway to these under collateralized loans, but it's very much still emerging. But the over collateralized lending use case is the one that's kind of grown so far. The last one, which is actually we're going to talk about here in 15 minutes or so, is flash loans. So flash loans, you don't actually have to have over collateralized lending, but we'll talk about how those work here in a second. They're definitely for the experts on the call. All right, Anthony, do we have any questions coming out of that section?
Let's see. So what are some examples of protocols trying to do non-collateralized loans? That's one question. Another question is, for under collateralization, has anyone been working on having traditional finance, i.e. banks, join the system by acting as guarantors or borrowers? Banks can do credit analysis and then back a repayment should the borrower default. Question.
Yeah, so both great questions. So on the first, some of the protocol names escape me. You could easily build a web application on top of Aave where you could use their delegated credit system to build that out. And I believe there are either hackathon projects or actually new protocols that are building them out. Another thing I'll say there too is, along with under collateralized loans, people are also working on a lot of stable borrowing mechanisms. So Aave actually has some stable borrowing rates built into their protocol, and I think there's Notional and a couple others that are going after that stable rate problem. Follow up with me on Twitter, and I'll find you the names of those protocols that have under collateralized loans. And then in terms of banks, absolutely. Here at ConsenSys, we kind of have one foot in the traditional financial world and then one foot in the DeFi world. And you best believe that banks are looking at these types of things. There's certain questions that they have, and there's a learning curve for them to get kind of ramped up on the space. But they're seeing these numbers, they're seeing the value behind issuing these types of things, and so it's absolutely coming. There's some education process with things like banks and with regulatory organizations where they need to learn about it and they need to understand it. They need to understand the benefits and the drawbacks before they jump in. But I've seen these crypto cycles before. It's really just going to be a matter of education, a matter of a couple years before they get comfortable with transacting in these environments.
Excellent. I guess we can continue, and then we'll keep answering these async.
Sweet. All right. So, once you have the basics of stablecoins, of decentralized exchanges, of lending, now we're going to go a little bit deeper down the rabbit hole and some of the crazier applications that exist in the ecosystem. So we're going to start off with asset management. So the traditional world counterpart, if anybody on this call has used robo-advisors like Betterment, like Wealthfront, the way they work are kind of like a souped up digital version of an asset manager. So you give them some of your capital, you describe what your investment goals are, right? Like I want to retire in 20 years. I want to buy a house in 5 years, and they recommend the right portfolio for you to reach those goals, right? Maybe it's 80% stocks, 20% bonds, maybe it's more income driven. Here's the investment, here's a diversified portfolio that meets your kind of investment goals, and they take a small fee for doing something like that. Again, Betterment, Wealthfront, and the like are startups that are worth lots of money with lots of people and lots of software engineers and are providing a fantastic service. But we also have now asset management in the DeFi space, right? And so instead of having these startups with all these people involved, we have a couple thousand lines of code that are doing something very similar. So we have Yearn here, we have Set, and we have Harvest Finance. So with these type of protocols, you can do something similar, right? I can send them my tokens, whether that's my Ether, that's my USDC, that's my DAI. And what they'll actually do in a smart contract driven way is actually invest that to meet whatever goals that the particular contract is set out to do. So that could be things like optimizing for yield, right? I want to be making the most money off my money that's sitting in my wallet. Maybe it is optimizing for making income driven investments or governance focused investments, or maybe broad access to a bunch of different DeFi sectors, right? Like I don't have the time to research 20 different projects with these crazy names and all these different discords. Maybe I'll just deposit my money here, and then they're going to spread them out amongst the 20 top projects and make sure I have exposure to all of them, so I don't have to worry about it, right? Let the experts do it. And because these things are thousands of lines of smart contract code rather than these heavier organizations, a lot of the fees that would be present in these startups get completely flushed away, and I'm making the bulk of what my capital is kind of producing within them. Caveat is that a lot of these asset management systems are probably less than a year old. A lot of them are very, very sophisticated in some really interesting ways. And so, definitely beware. This is why it's in the going deeper section. Definitely beware if you're starting to play around with some of these different things. Some of them might have, some kind of technical bug that provides, some kind of exploit within the smart contract that a hacker might be able to use. Also, some of them have, different financial risks, right? Where maybe their price feeds aren't as good as they think they are, and there's some kind of exploit that can be done to, remove some of the tokens that you've deposited when they shouldn't be removed, right? So there are risks associated with these things, but they're getting better and better as new versions, new minds, new developers are working on them. I would say asset management is probably one of the most exciting sectors within DeFi, I think, over the next 5 years. I think we're going to end up doing things that Betterment and Wealthfront could never really do, and it's a very exciting space to watch. All right, so I mentioned to you guys, I originally gave this talk about a month ago. That's why I put non-fungible tokens or NFTs in the going deeper section. If I did it today, I'd probably put them in the getting started section, because they've now been written about in every media publication across the board. I think I saw yesterday the New York Times is creating its own NFT for a column that they're selling. They're music artists and digital artists and gaming folks that are creating these things all over the place. So NFTs, were a more complex topic a month ago, and now they're much more in the mainstream because of all the innovation and action and publicity that they've gotten lately. So what is an NFT? So an NFT, or non-fungible token, is just a unique item, right? I always equate this to a famous art piece like a Picasso piece, or something like a basketball card, right? When LeBron James entered the NBA 20 years ago, there was probably 100 different LeBron James rookie cards that you could buy way back then. If you held it through this whole time, that might be worth a whole bunch of value because he's had such a successful career, right? These kind of real world collectibles, whether it's arts or trading cards or stamps or all types of things, have existed for years. And now NFTs are simply bringing that online, right? When we actually bring that collectible or that unique item onto the blockchain, we have a built-in certificate of authentication. We know it's real, right? We know it's not just a fraud. We also know the entire lineage of the history of it. So ever since the creator made it, maybe it's sold in an auction initially, and then it traded back and forth on a secondary market. All of that is recorded on the blockchain. And so there's a lot of trust around, an item is what it says it is, right? Looking at the landscape here, a couple of my favorites, NBA Top Shot has absolutely grown like crazy. I'm sure a lot of people on this call have read about it. The really interesting thing there is rather than buying and selling, basketball cards, they're actually buying and selling individual moments, right? So there's an infinite number of moments that can be sold. That awesome dunk that LeBron did last night, that you can buy it the next day and then hold it if you think it's gonna go up and down. Some other notable ones, CryptoPunks, Axie Infinity, and then the other really important one to watch is just a lot of the different marketplaces like OpenSea, Rarible, and Zora, and a lot of the issuers that are really working with these creative communities to educate them about NFTs and how they can actually use them. Going deep just for a second here, and I'm going to speed up things a little bit based on a time check. When we really think about the future of NFTs, we need to figure out how intellectual property law applies to non-fungible tokens, right? These are smart contracts, so we can encode any type of logic in there. We can encode copyright law if we wanted to, but we're going to need the right systems to enforce those copyrights. And then secondly, we're going to need the right systems so that fees for secondary market trading or secondary market utilization go to the creator or go to other folks within the ecosystem. This is really, really hard to do with art or baseball cards because they're in the physical world and you and I can trade and then just not tell anybody. But when all this is done on chain and it's programmable via smart contracts, the number of financial models we can play around with for this secondary market behavior is absolutely endless. So that's very much emerging for the space. And lastly, I'm going to quickly touch on risk management protocols. So when I say risk management protocols, I want you to just think of insurance. So just like I could go to AIG or Liberty Mutual and get a life insurance policy, I could pay into my premiums every single month, and then I get a big windfall if something catastrophic were to happen, or my family would get the windfall. Similarly, we have that insurance contract can also be a smart contract that's on chain. And a couple of the most popular ones here are Nexus Mutual and Cover Protocol. The type of insurance risk that has been most popular so far has actually been the risk of some of those smart contract hacks or exploits that I mentioned earlier, let's say in asset management protocols, right? Because these things are really, really interesting, but really, really new. A lot of folks are saying, hey, if I deposit my $100 into Yearn and there's a technical, there's a bug that I didn't know about, then a hacker comes in and takes my funds, I want to be covered for that type of incident, right? So with things like Nexus Mutual and Cover, you can actually buy an insurance contract on that $100 deposit. So if there is some kind of technical bug or some other type of Oracle exploit or financial exploit, you can actually be made whole. You can still get your $100 because you took out an insurance contract. Insurance is fascinating in this space, especially when you think about everything that smart contracts can do. So definitely a space to watch is in risk management. Anthony, any questions here? Should we take them to expert level?
There's some questions here. Let's see. Here's an interesting one. How are these portfolios, i.e. these investment management DeFi apps, built? Is this done algorithmically or through a smart contract, or is there a human involvement there?
Yeah, that's a great question. The answer would be probably both, right? So think of it as, active portfolio management versus passive portfolio management, right? So at its very basic layer, you have a shared account or a shared capital pool where a bunch of people can put capital in and they can pull their capital out basically at any time. And how that capital gets traded can be dictated by an individual, right? So if I look at a particular person on the blockchain and they have a fantastic trading history and they're much more plugged in than I am, maybe I'm depositing my capital and then delegating control to these individuals because they're going to do the best job managing my money. Alternatively, if I don't want humans involved and I want this strategy to be, completely smart contract controlled, there's systems that, you deposit your capital and it's controlled automatically through just smart contract logic, right? There are even interesting systems where different, multiple people put forward different trading strategies. And then based on the one that is doing the best, the capital flows over there, right? And if they start going downhill, capital flows over here. And so the types of kind of strategies that get built, and these are completely open to anybody in the community, are absolutely fascinating. It's really no different than what hedge funds, have done for years, but we're doing this, in completely open source code that anybody around the world can access.
Excellent. And I guess to dovetail onto the next section, where do synthetics fall into DeFi? I imagine expert level.
Perfect. Yeah, what a great segue. Thank you to whoever asked that one. So we're going to enter ludicrous mode here for a second. We're going to talk about kind of the very, very cutting edge of the DeFi space. And please, 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 for anybody on this call, make sure you get familiar with stable coins, decentralized exchanges, some of these first few applications before jumping over here, because there are certain risks involved. These things are very, very new, and there's real value that's being exchanged around. But expert level is particularly interesting because these are things, for the most part, that a lot of times aren't even possible in the real world. Let's look at synthetics and derivatives here for a second. So I come from the hedge fund space. If you actually look at the derivatives markets for traditional financial players, they're actually bigger. The trading activity that occurs there is bigger than the amount of stocks that trade on a daily basis, right? So derivatives are actually an even bigger market than just trading, equities in the United States back and forth, right? So this is the potential here is absolutely massive. Whether it's some kind of options contract, futures contract, what have you, in the traditional world, just think of this as a legal agreement, like a legal contract between one financial institution and another, that I'm going to pay you XYZ if ABC happens, right? So there's a bunch of legal jargon that goes into it, but you can create all types of really interesting financial instruments that allows these super sophisticated traders to match the type of risk that they want to get to, right? This leads to all types of crazy bundling risks like credit default swaps and all types of crazy stuff, and has been done on Wall Street for years. Now, anybody that has access to the internet and can learn a little bit of Solidity code can code these things up in derivatives protocols as well. So synthetics is one of the biggest players in this space. They basically have created a protocol where you deposit some capital and then you can trade back any type of asset back and forth super seamlessly with actually no slippage fees either. So you can trade things like a Tesla share, and this is a synthetic version of a Tesla share. You can trade, the S&P, you can trade currencies back and forth, you can trade all of these types of things, but you're not actually trading the underlying share or the underlying asset. You're trading a synthetic version of it that exists entirely via smart contracts. Really, really innovative, and I definitely encourage you to learn more. Similarly, this year we've seen a variety. We have perpetual protocol here. There's also ribbon finance and a couple more. A lot of people believe that these legal agreement derivatives that Wall Street trades back and forth are actually much more efficient if they just exist as smart contracts, right? You don't have to depend on big banks, Credit Suisse and Citigroup to go to them and get this kind of crazy financial asset because it matches your risk portfolio. You can actually read the smart contract and get a similar risk allocation without depending on the big banks, right? Everything is encoded in the blockchain, and so it executes automatically. So these programmatically settled derivatives contracts, a lot of people believe that this is ultimately going to be the killer app for crypto. We are just seeing a lot of those traditional super sophisticated players moving over into smart contract blockchain and crypto space. And so I totally expect this space to basically, mature by 10 years over the next 2 years, because you're getting these, these expert minds that know them well from the traditional world, building the equivalent or even pushing the boundaries of what can be built in these smart contract systems. The last I'll say is we talked about wrapped Bitcoin earlier. If you want to use Bitcoin on the Ethereum blockchain, what you basically have is a tokenized representation of that Bitcoin. So anytime that you want, you can redeem a specific wrapped Bitcoin token for Bitcoin, but it's not an actual Bitcoin itself, right? It's a wrapped version. It's a synthetic version of that Bitcoin that you can use in decentralized exchanges or lending applications or what have you. So derivatives, very much emerging, very much expert level. Next, we're going to talk about what I call token drops, also called yield farming, if folks are familiar with that term. So less than a year old, really got big when Compound announced their program at about midway through 2020. Yield farming is fascinating. It's also one of those things that you can't really do in the traditional financial system, right? It's fascinating because at their base, all of these protocols that are providing financial services, whether it's decentralized exchanges, lending, asset management, at their core, they're all networks, right? And what a network is the more people that participate, the higher value of that network, right? So, when there are 10 people that are participating, it has some value. Maybe they're trading back and forth, but when there are 10,000 people or 10 million people, you get better price transparency, you get better liquidity, you get bigger volumes. So all of these protocols want to add more people, add more capital to their networks. That's kind of the name of the game in DeFi. One way to really incentivize people to grow your network and therefore the value of your protocol is to give people a piece of the protocol or give people a piece of the governance vote to the protocol. So, for instance, what's a good example? SushiSwap came out last year. It was originally a fork of Uniswap, but it started adding a bunch of more innovative features in some ways, and it allowed for yield farming within it. What that basically means is the people that are participating, whether it's contributing capital or trading back and forth, they earn a little bit of that sushi token every single time that they interact with the protocol, right? And so they're getting a piece to the upside of SushiSwap, right? So if they invite their friend, they invite 10 friends, they invite 100 friends, that network becomes stronger, SushiSwap becomes stronger, and the amount of tokens that they're earning for participating in that network is allowing them to have a piece of that appreciation. The one real world example, the real world parallel I would give here is, Facebook's a network too. The more users it has, the more value it has, but they're not going to shave off a piece of their cap table for every single new user that joins, right? And so as a result, Mark Zuckerberg and a whole bunch of other executives were the ones that saw all the appreciation of value, even though it's all the users that are uploading status updates and photos and creating groups and providing all that activity that makes it valuable. But they don't see any of that upside, right? This concept of yield farming or governance tokens that you distribute to your community, now there's a whole segment called community tokens that's really up and coming, allows for the participants in those networks to have an upside in it for contributing all that value. Again, it could be done in the traditional world, but it would be an operational mess. But when these things are just a couple lines of code in a smart contract, it's so much easier to distribute these types of things. Next one here is flash loans. So along with yield farming, flash loans is one of those functions that absolutely can't exist in the traditional financial world. So we talked about over collateralized loans earlier. Like, why would you want to deposit $150 to then take a $100 loan? Flash loan solves that, right? So you can actually borrow that $100 or borrow $100,000, borrow $100 million even, without having to deposit capital, as long as you pay back that loan in the same transaction. So what that means is these savvy technical traders, they write a very simple computer program or computer script that may borrow a flash loan at the beginning. They're going to do some kind of trading activity in the middle, and then they pay back that flash loan at the end. And if they're savvy about it, they made some kind of profit along the way, right? And so when we talk about democratizing finance or opening finance to everybody, flash loans is the great equalizer, right? Because now anybody that has access to an internet connection and can learn Solidity can write one of these very simple computer scripts and have access to capital as much as large hedge funds have access to, because they have these things like flash loans. Now, as you can probably imagine, they're very, very powerful, but they can also be very, very dangerous in some cases. So the majority of flash loans use cases are being used for arbitrage. So there's some price disparity between trading venues on these decentralized exchanges. I can buy it for $10 over here and I can sell it for $15 over here. I'm going to take out a big flash loan and I'm going to kind of I'm going to exploit that price difference and hopefully bring the prices back into alignment, but I'm going to profit off that trade, right? So that type of arbitrage activity is a super popular use case for flash loans. Unfortunately, flash loans can also be used for certain manipulative practices, right? So, if I'm, looking at this $10 price and this $15 price, there might be something I can do to make these markets even more uneven and capitalize on that bigger price disparity and make even a bigger profit in these trades. So there's kind of a line between this arbitrage or this kind of manipulation type activity that people are still trying to figure out. And with flash loans, anybody has access to a lot of capital to exploit these types of things. So this is very much kind of a push and pull situation. People are trying to figure out what these things are used for, what are the best ways to combat some kind of flash loans exploits. And this is still very, very emerging for the space. But again, this is expert level. Please don't play around with flash loans until you've gotten yourself up to speed and understand the risks. Lastly, I'm just going to quickly talk about money games because they're very interesting. I call these things money games. They're basically the intersection of gaming, especially mobile gaming, crypto, and then also this NFT and digital collectible space, right? So, you can play Candy Crush or Fortnite or Clash of Clans, all these fun little games where you're putting together strategies and you're earning points and you're leveling up. With these money games, every time you're earning those points actually translate into real world value, right? You can take those points and you can go trade them on Uniswap for USDC or Ether, or cash them out and go buy a present for your wife. So this whole idea of like having these in-game rewards that used to be just like, you got a pretty color, you got to customize your character a little bit more. Those things actually translating to real value is this emerging sector of crypto that we're all really excited about, and has frankly just been more and more heightened because of the NFT craze that people are kind of getting into, because gaming items are becoming more and more on-chain anyways. Why don't we start rewarding people with on-chain items as well? So I promised 10 use cases in not under an hour, but slightly over an hour. Hopefully this gives you a fantastic view of the DeFi landscape. There's also much, much more that we didn't get a chance to cover, so we may have to do a follow-up at some point. But these 10 use cases, I think everybody on this call can say that they're, they're quite knowledgeable of the DeFi sector if you understand these 10. Derivatives, yield farming. Anthony, did we have questions on these?
Here's one. Could you talk about the max debt ratio and liquidation debt ratio when doing leveraged yield farming that might end up in your portfolio getting liquidated? How are these calculated? This may require its own webinar, actually. We'll get to you on that one.
And I think we're also straying into crypto as an asset class a little bit there. All I'll say is, when we talk about getting started, going deeper, expert level, leveraged yield farming isn't possible if we don't have lending facilities. Lending facilities aren't possible unless we have stable coins. So you're really getting an idea, if you're doing leveraged yield farming, you're really getting an idea on how these different money Lego blocks fit together to create this new crazy experience. Yeah.
One more from, let's see, is Compound's native token a yield farming mechanism?
That's a great question. I think most people would say, yeah, Comp is a yield farming mechanism. So the Compound governance from the last time that I checked basically awards a certain amount of comp block by block for anybody that has deposits or borrowing positions within the protocol. Last time I checked, I think the DAI market on Compound has some of the highest yield farming rewards, and some of the other markets are a little bit lower. But that's basically saying, hey, we're rewarding our users, we're rewarding the people that are depositing or taking out loans with a share of governance. And then they've been really, really aggressive about getting people involved with new proposals to make Compound better, to tweak risk parameters, to add new assets. And we love to see that type of community kind of surfacing around, a core financial service like Compound.
One last one. This is interesting. Flash loans is for very short term, daily loan, let's say. What about medium and long-term loans? Let's say 2-year terms.
Yeah, that's a great question. So, obviously we have the overall collateralized loans that you can take out today. Again, it's almost like a little bit of a golden goose for the people that are going after these under collateralized loans for medium and long term. For my bet, there's got to be some kind of reputation surrounding under collateralized loans on chain. So that could be, hey, I'm looking at your Ethereum address. I see that you have a stellar history of paying back all of your loans over time. I also know that your identity is tied to that address. You own a bunch of NFTs. You participate in a bunch of governance activity. I don't think that you're going to just run away with this capital because you have such a brand built around that Ethereum address. So because I don't think you're going to run away with this capital, I might be willing to provide you a loan without you putting, an over collateralized amount down. And so those models are very much kind of emerging, but that type of idea of a decentralized credit score, decentralized reputation backing these loans is going to be one to watch over the next year or two.
Excellent. So I guess we can answer the rest of these questions afterwards, since I guess we're running over time. We will get to your questions. This webinar will be available. So, and perhaps there'll be a part 2. I think the demand and the excitement, and some people are saying it's been one of the best webinars, if not the best. So I'm very excited about this. And Corbin, it's been amazing. I've learned a lot. I'm sure our audience has learned a lot.
Awesome. Let's just finishing up here real quick. Looking ahead, you guys have already leveled up your DeFi game quite considerably. Looking ahead, we expect this growth to continue massively. If we look at the growth from late 2018 through 2019 and even last year, this graph has probably gotten 10x or 100x bigger just in the past year as well. So, definitely, DeFi is something to continue to keep tabs on. And I actually encourage everybody to get involved that's listening in here. A couple things to flag. It does move incredibly fast. Please don't be discouraged by that innovation cycle. Like, I was out on paternity leave for 3 weeks and I come back and there's a new top 10 applications everywhere, right? Like it's moving incredibly fast. That's a good thing. Over time, that signal will differentiate from the noise, and you'll kind of see what the killer apps kind of emerge. So don't be too discouraged if you're always overwhelmed every time you check in on DeFi. Keep an eye out on layer 2s. I think gas price came up as one of the biggest one of the biggest headaches for interacting with DeFi today. Layer 2s are coming. Layer 2s and side chains are coming. There's going to, if you look at Polymarket and a couple other, on top of Polygon / Matic, like you're starting to see DeFi applications in a way with cheaper transactions, faster transactions. All this stuff is coming. It's just kind of emerging rapidly. And you can still interact with Ethereum layer 1. It's just a bit expensive at the moment. But that stuff is going to emerge over the summer, and we're really excited about it. Lastly, we always want to be cognizant of the regulatory bodies. At the end of the day, right? Like they're all for innovative financial services that make things more streamlined, right? Like I think everybody wants to get rid of these filing cabinets that are, gathering dust at the big bank. And if we can show them how some of these decentralized alternatives provide a lot of value for consumers, if they have the right safeguards, I think everybody's on board for that. But there is a continuous learning process that they're going through. And that's going to be kind of an emerging discussion. A couple links here if you want to get involved. The biggest one would just be download MetaMask if you haven't. That's going to be your gateway to a whole new beautiful DeFi world, and play around with that swaps functionality if you haven't already. And Twitter's the place to be to discuss these types of things, whether it's myself or other folks at ConsenSys. We love folks getting involved with this space, and encourage you to ask questions and learn more. So thank you so much. I absolutely love talking about this topic. The questions were out of this world good. And so I'll pass it back to Anthony to close this out.
Well, we've received a lot of questions. We'll get back to you. Those we haven't answered at the moment. There are still a significant amount of questions because it's a significantly large sort of field. And we'll take time to answer these. We thank you again, no matter where you are. Thank you for taking the time to be with us and go over and just that engagement from ConsenSys to you. We're very grateful for your time, and we hope to see you again for perhaps a part 2. Thank you.
Thanks all.
Bye, guys.